Hi, everyone. Welcome to the Timing Research Show for January 25th, 2016. My name is David Kosmeter. I'm the creator of Timing Research. Today we'll be talking about the 122nd weekly report from Timing Research. If you haven't had a chance to take a look at this yet, just go to TimingResearch.com/reports. You can download it there. I have Matt Buckley hosting for me again today, so I'm going to go ahead and turn it over to him. Thanks for coming back and being on the show, Matt.
You bet, David. Thank you. All right, folks, let's go ahead and get airborne. Welcome aboard. My name is Matthew Buckley. My call sign is Wiz, and yes, my parents like me, actually, so that's not my God-given name. I earned that as a call sign flying the F-18 Hornet for the United States Navy for about 15 years. Graduated from the Navy Fighter Weapons School, which many of you know as Top Gun, and also flew 44 combat sorties over Iraq. Decided to go into the options world. I was a self-taught options trader, and ended up being the managing director of strategy for Peak 6 Investments, one of the largest volatility arbitrage firms in the world. And then after 3.5 horrible Chicago winters, I decided to head down to South Florida here. Actually work in Miami today, in our Miami office, and I'm glad to be here. Also joining us today, we have Corey Rosenblum of AfraidToTrade.com. Corey, why don't you tell us a little bit about yourself and what you do at AfraidToTrade.com?
Sure, Matt. Thank you for having me, David, on the research show here. Good to be back with you all. I'm actually from Alabama, but I'm escaping the East Coast snowstorm blizzard here in Los Angeles, California, just south of Hollywood, which is kind of my dream to live here, and trading has made that possible. I started investing back in 1999 when the market drew a lot of people into it, but then rode down the bear market and turned to technical analysis back in 2002. And from there, just found the passion, interest into a hobby, into a career, really. And I focus more on short-term trading tactics, S&P futures. I take a swing trading approach to the intraday charts, and of course use psychology in that, balancing greed and fear. And I teach traders to really manage emotions and do trading tactics, success tactics, and intraday and short-term strategies from the Afraid to Trade blog and membership.
That's awesome. I think you nailed it, Corey. Being a tactical trader now is critical in today's market with everything that's going on, man. And I'm sure we'll talk about that. Andrew, are you up, my friend? We're supposed to have Andrew Keane of Alpha Shark joining us. He was having some comm issues earlier. I'm seeing his smiling face and pearly whites there. So if he comes up, we'll certainly have Andrew let us know if he's up and can join us, and potentially Steve Lentz of Option View. Okay, I think he was having some comm issues as well. So Corey, it might be you and me holding down the farm, my friend. And
we get this. We get this.
Yeah, we got it, man. All right. Well, if everybody has a copy of the survey handy, or you can click over to David's tab there, you can see that he's got it up right now. Let's just dive right into it, Corey, and you and I can hack some of the stuff out and see what's going on. So what, in your opinion, developing events, technical, since you're a very big technical guy, fundamental, seat of your pants, you name it, will you be watching out for during this trading week that might have a positive or negative impact on the S&P 500 or other U.S. markets?
I'll show the charts in a moment, but just in terms of looking at the bigger picture, really nervous about this broader possible head and shoulders on the weekly chart of the S&P with these divergences and breadth not really doing that well, and just almost a rounded reversal or inverse saucer pattern. That's a bigger picture weekly chart. Some similarities to 2007, but that's getting ahead of myself. For today's week and going forward, I'm of the bounce thesis that we're coming off that inflection low, 1820. I want to see this market above 1900. I really, really do, to get a sustained bounce. There's a little bit of an inverse head and shoulders pattern. All that means is probability does seem to favor a bounce, and I play on dominant and alternate expectations or theses, just probability, nothing guaranteed of making predictions. If the market does break above 1900, I do think we'll see a bounce up to about 1950. So I'm aligned with the survey participants this week, and we'll see what the other panelists say. But if the market's above 1900, I'm going to go ahead and expect this sustained bounce, looking back to potentially August 15th or August 2015, and in September we had this similar boom and sort of an inflection rally back up to the 2000 level. Not quite targeting that just yet, but that's my play. And if the option takes place, if we're under that, goodness gracious, help this market. I'll just say that.
Hey, Corey, real quick. I don't know if you're trying to share. Are you there, Corey?
Yeah, I'm here.
Okay. Sorry, man. I think I might have got bumped out. Some stray trons zipping around the internet here. There you go. Now I can see your charts. I don't know if we were seeing them before there. So
no, I was doing verbal. Yeah, I'll do the charts in just a little bit. Yeah, just trying to do an overview.
Oh, great. Okay. Let me fire away with mine here. Let me go full screen, and then let me. So for events going on this week. There's a lot of stuff going on. There's China data coming out. Well, let me just go over to here. Key events in the coming week. I know we're talking about U.S. markets in the question there, but we have a Bank of Japan meeting later this week. We got some European meetings as well, but some data out of Japan, including CPI. And also some China data, but we're also going to hear from the Fed. We're going to hear from the case. Actually, let me just go over to here. We got case tomorrow. We'll get S&P composite, the Case-Shiller flash services PMI, and then the conference boards consumer confidence numbers. I think those are usually some market moving events. On Wednesday, we get the FOMC statement and the Fed funds rate. Now, I think there's a slim to none chance that we're getting an interest rate this week, and Slim just left town. It ain't happening. But it is going to be interesting to see what the Fed has to say this week, because we know that they're not stupid. They watch the markets as well, and they know that we're kind of in a pretty big firefight right now. So are they going to say anything soothing? Are they going to be more accommodative? Maybe we'll throttle back on the interest rate game plan, or hell, they might even drop in the word QE. Who knows, man? Stranger things have happened. Durable goods orders, and then there's the Japan stuff later in the week. And then on Friday, a lot of Eurozone stuff, German, French, and Eurozone in general. And then we'll get a Chicago PMI and advanced GDP. Now, the reason advanced GDP is important is because GDP comes out in three types: advanced, preliminary, and final. So advanced has the biggest impact because it's the first. And look at this. I mean, so this 2.0 print was a big revision up from 1.5. I think that's a lie. Look at how embarrassing this is, folks. An anemic point. There's nothing in front of that decimal point. That's what's shocking to me. So a lot of potential events to spook this market, and I love the way Corey mapped out some of the technical levels. I'm certainly not a Jedi master like Corey is with the tech stuff. I feel, and this is after 20, 25 years of trading options, a little dead cat bounce-ish, maybe. Why? Oil and stocks are at their tightest correlation in 26 years. So I really think that, and I was just looking at some reports earlier about excess inventory. Some Saudi Arabian oil minister was quoted today as saying, "We don't care what the price is. We're going to keep pumping oil." So I think this might be a little bit of a dead cat bounce this week, and I'm actually selling into it. Okay. So Steve, it sounds like you might be joining us right now. Steve, yep.
Steve, you have to unmute yourself.
There we go. Can you hear me okay?
You bet, Steve. Hey, it's Matthew Buckley, Wiz with Top Gun Options. How are you, my friend?
Thank you very much. I'm doing very well. I apologize so much for being late here. I have a new laptop, and I had to wander through all the Hangout and the blocking this and unblocking that, and oh my word. Anyway, we're here.
No worries, my friend. I'll tell you what. Why don't you give us a little bit of an intro about yourself and what you do at OptionView?
Sure. I'm with OptionView Systems. We have an educational arm called Discover Options. We're primarily a mentoring company. The one-on-one mentoring experience is what we specialize in for options traders that want to do option overlays, want to get into directional spread trading, and then as well as income trading with non-directional type premium selling strategies. And so what I do, I get into technical analysis quite a bit, and we try and combine technical analysis with option spread construction, and so that's what we're all about here.
I think Matt's muted.
Am I still here?
Yep, sorry. I'm sorry about that,
Okay.
Steve. I was actually the one on mute, so my apologies.
Okay.
Corey Rosenblum from Afraid to Trade and I were just talking about key events in the week ahead that might move the market up or down, and I know you saw a copy of the of David's report and what the crowd said. How about you lay it on us? What events do you see this week that are going to drive the market either or higher or lower?
You're talking to me. I'm Steve.
You bet.
Perfect. Okay. I think the the Feds are meeting tomorrow and Wednesday, so that announcement can certainly move the market. If it would depend on what comes from those meetings, but primarily from a technical analysis standpoint, we're seeing the market has come down into the 1860 to 1900 range, and you can go back months and months, and that's kind of been a support and resistance area going way back. And that's converging with some interesting Andrew Pitchfork type confluences, and so I see it's reached an area of support. So many different technical analysis approaches are saying that this is an area where the market of great interest, where the market can gather itself and then retrace back up, perhaps in a bear market rally. We'll see what happens after it, if and when it rallies, but that's kind of particularly, I think on the weekly chart, you see a huge reversal bar last week, and if it breaks through last week's high, which it hasn't yet today, then I think that would be on the weekly chart a clear sign that we're in at least a bear market rally, if not something more after that.
Okay, interesting. We might be 2v1 here. Okay, so Corey, based on what you said previously, what is your sense? Where's Friday's close going to be? We're going to be open or not open? Are we going to close higher or lower than we are right now? And what's your level of confidence, so to speak?
I'm going to target, that's an if. I'm expecting, I'll tell you my dominant expectation is that we do continue to bounce. I'm not thinking we're going to make new highs. I do think, like you do, it's a bear market rally, but the market swing structure just has, if you look in the weekly chart, down, up, down. Probably the next move is up. Again, bear market rally, but still probably Friday would be a higher close. I'd put a 75, 80% probability of confidence, at least at that point, just based on swing structure, other factors. But just kind of quick answer, higher.
Wow, okay, so we got higher. All right, Steve, over to you.
Higher, 65%. 65, I agree with much of that. And if it breaks last week's highs, then absolutely higher. But we have a little ways to go yet. But yeah.
All right, so we got two hires with a 70 and a 65. Of course, the answer is lower. You're both wrong. I get everything that you guys are saying. I just don't feel. I mean, obviously, people. The only time somebody said I got out here and got in here is at a cocktail party. Nobody rings a bell at the top of the market and says, "All right, everybody out of the pool," and nobody sounds a horn at the bottom here saying all clear. However, I use a lot of data. I love doing intel gathering, and obviously before I ever went on a mission, I did a hell of a lot of intel gathering. The quote smart money. Here's why I don't feel it yet. I'm the chief development officer of a hedge fund up there in the Great White North, and not to say that we're ginormous, or I just know we're not getting long, and the smarter guys in that hedge fund talk to a hell of a lot smarter guys than me. You know, when you got Gunlock from Double Line Capital out your way, Corey, in L.A., a guy's swinging 85 billion around. He's like, we're going lower. I'm going to cash. You got, and it makes my skin crawl to agree with this guy, but George Soros sitting there going, "Hey man, this thing's going lower, and I'm not getting long." I just don't feel it. I don't see the follow through today. But if we do, I agree with Corey. If we do hold here with a little bit of airspeed, then we're going to see a bear market rally. But I need to see a little bit of airspeed on the jet here, and it just doesn't. It feels wallowing. So I'm going to go lower, and I'm going to go 90%. And the only reason I'm saying 90% is I just got filled on a weekly options bear call spread, so it better go low. I just need it.
Marketing lower.
I'm doing my own marketing here. It better be below 1930 by Friday. So that's my take on that. Okay, and any thoughts on that, Steve or Corey? We can take it on
real
talk.
quick.
Yeah, go ahead.
Real quick. This, in terms of intraday, we looked at the daily chart. This is my intraday ES 30-minute chart, and this is what was the inverse head and shoulders or V spike reversal. Not saying it's going to go much higher, but just that if the market does break 1900, it probably trades through to one of these Fibonacci levels. And that's going to correspond. I would say 1950 is my target early. If it's an inverse head and shoulders, that's a classic chart pattern. The target's just under 2000. But it's not triggered yet, has not happened. But if the market does break 1900, that's going to put me bullish and trading bullishly up to one of these three levels. That's kind of my 5-second version of it. If not, it goes down Tesla's. That's be interesting.
That's exactly right. If it is a dead cat bounce, it's a look out below moment.
It should be bouncing higher than this, though. Honestly, unless this is a collapse of the market should swing its way back up and retest something, and then keep going lower. It needs to at least draw on the short term.
Exactly right. Yeah. That's what I feel, Corey. Is that it just doesn't.
It's feel like a good bounce here. It needs to go higher.
Correct.
Than that.
It feels like, speaking to all our friends in the Northeast, it just feels like it's sitting in the driveway trying to start the car, and it's just not igniting there. Steve, what do you think?
Oh, I'm not looking at intraday charts too much. I'm looking at the daily, where it's made, one could say, what did Arthur Merrill talked about, a W pattern. We've had 2 attempts now at most recently here. This would be the second attempt to break in the previous day's high, and having a reversal. So it would be a W reversal pattern on the daily. Weekly, again, last week's high. If that gets taken out, I would be much more confident and have the bullish position there. So maybe I'm in the minority there, but
okay.
I'm looking at good things happening if last week's high is taken out.
Yeah, I agree.
I agree. I'm certainly going to agree with that. So we got our confidence with how much higher that's going to be. Let's go to actually let's look at question 4. And Corey, I know you covered some of this, but what styles of trading or methodologies have you had the most success with? Why are you a successful trader, would you say?
I review making mistakes, learning what works, learning what doesn't. Having mentors, talking with traders at the expos, etc. I got the CMT designation, the Charter Market Technician, and learned just about every indicator you could possibly learn. And my trading suffered because of it, honestly. It just was so much information. Elliott wave this, Fibonacci that, indicator this, and it really did cause the trading to be more muddled and confused. So I was successful initially. Then the more I learned, it became more difficult, and I went back to the simple, and that trading has snapped back. This is back in 2008, 9, and 10. But it's mainly the 3 principles that guide all of my decisions. Is that it's 3 price principles from Dow theory and beyond. It's that if a trend is in motion, odds favor continuity of the trend. Trend continuity principle. 2, momentum is a leading indicator of price, meaning if there's a divergence, typically favors a reversal. And if you see higher prices with higher volume, higher momentum, higher breadth, higher internals, odds favor continuity. So momentum leads the price. And the other one is the contraction alternation thesis, that price tends to move between periods of range contraction and consolidation, which is range-based trading, and then breakouts or impulses or really momentum-style trading. So it's 3. It's trend continuity, momentum as a leading indicator, and of course the range alternation principle. Just price principles, honestly. Trend line analysis, not anything fancier or fancy schmancy, just simple, simple.
Well, if it works, it works. So well done.
For over 100 years.
There you go. Okay, Steve?
Yeah, we focus primarily, and I do, on premium selling, credit spreads, which can take the form of just directional credit spreads, even directional diagonal credit spreads. Butterflies are really, an iron butterfly is really two credit spreads kind of combined, and you could split that off and make it a broken wing butterfly, and we specialize in that. Our mentors do, as well as covered call writing, and then of course the condors, which is just another set of two credit spreads. So we have a bit of success with just credit spreads in various combinations, in various patterns and ratios, but primarily it gives you just a lot of room for error. You know, you don't have to be so precisely correct in terms of direction as much as just simply predicting at least when it's not going to move against you so bad. That's a lot easier to do than having to pinpoint a move right now in a velocity greater than a standard deviation, which is what you need when you just buy options or when you go long or go short, just the underlying. And so that's why we like option spreads. A lot more room for error, much more greater margin for error, and you make daily time decay while the market is determining its direction. So that's what we have hung our hat on.
I couldn't agree more, Steve. I love being in the house. As an options guy, I'm the same way. You want to be the car dealer, right? So, you know, somebody runs into the Miami Ferrari dealer down here with their midlife crisis. You know, when they peel out of the parking lot, you're counting your money going back to the office. There's immediate time decay with that guy. Halfway down the block, if his significant other calls and says, "Hey, your midlife crisis is over. Take that thing back." As soon as he pulls back in the parking lot and goes to me, "Hey, can you buy the car back?" I'll go, "Yeah, for 50 grand less." So I like being in the house, and I couldn't agree more. So spreads, great idea. Love selling that, especially with volatility being high right now. One of my wisdoms is when vol's cheap, you buy it. When it's expensive, you sell it. So whenever vol is expensive, when options are expensive, you end up selling them. So I couldn't agree more. Andrew, did you just join us?
Yes, finally made it.
Andrew Keane, ladies and gentlemen, standing ovation for Andrew. Ooh, golf clap. Ladies and gentlemen, Andrew Keane is joining us from Alpha Shark. He's one of my strategic partners at Top Gun Options. Always a pleasure having you, Andrew. Why don't you give everybody a quick intro about yourself and about Alpha Shark, and then we'll catch up with you on some of your opinions on what's going on.
Okay, I'll go quickly. I traded on the Chicago Board Options Exchange as an equity options trader for a decade. I left the trading floor. Basically, all the trading has gone electronic, and the trading floors are basically TV sets nowadays. And then I launched my company 4 years ago, and we run a lot of different products. We have a lot of educational courses. We run a live trading room where subscribers can pay to watch me trade during the day. I specialize in equity options and unusual option activity. We also do courses and indicators as well.
Okay, awesome. So Andrew, real quick, we'll go through some of the questions and get your take. Based on technical, fundamental, any other seat of your pants stuff, what are you watching out for this week that might have a positive or negative impact on the S&P 500 or other U.S. markets?
Yeah, I think the two big things are earnings. This is the biggest earnings week we're going to have. So we saw McDonald's report strong earnings this morning. Then we have Facebook later this week, Amazon as well. So earnings is one big thing I'll be looking at, and then the FOMC on Wednesday. So I think those are the two main factors. Other things I always keep an eye on is the VIX, which is the volatility index, and oil as well. As oil goes lower, usually the market goes lower. As oil goes higher, the market goes higher. But the FOMC and earnings.
Okay. Okay, awesome. Now, based on that, and give us a level of confidence as well. Based on everything you're looking at this week, do you think S&P 500 closes higher or lower by Friday? And what's your probability of success on that?
I would say about a 60% chance we move higher. I think that last week when we had a huge sell-off and then we rallied back very strongly and held that 1802 level, That's the key line in the sand for now. So 60% chance I think we go higher.
Okay. All right. It's 3-1. Okay, because I'm saying we go lower. I think we're in a little bit of a dead cat bounce. We're seeing a little bit of a rally, but this rally, I just looked at it. The rally's fading, just rally, quote unquote. Listen to me. The market moving in you're right, Corey. This 1900 level is a little squeamish, and it's
line of the sand.
It's acting like a magnet right now. It's either we're either being pulled up to it, or if we trade through it, we're being pulled back down to it, which is pretty interesting. But I'll tell you what, gents, and I like doing this when I host. I want to go around the room and take a little bit of time, take as much time as you want. Give us a nice juicy trade that you're looking at right now, either that you'd potentially put in your model portfolio, or one that you have on right now that our listeners could sit there and salivate at. And let's just go top to bottom. Corey, we'll go with you.
I tend to be on the futures market, so I do a lot of things based on the key levels and planning. So I play departure. So the trade I would look at, just for my own sake, is what I'm doing, is if the market does break above this key level, then I'm going to play this either as a multi-day trade or a swing or an intraday trade, series of them, playing retracements on the way up. So a lot of what I do is based on departures. So price, as you mentioned, good segue, price moving toward or away from a level. So I have that picture in mind, and what I do is trade in the direction of that move in a lower frame. So if we, and I try to be as neutral as possible without bias. If we fall, then as an intraday S&P trader, I'll be short selling the pullbacks, bear flags, and breakdowns. That would target the lows at 1853, thereabouts. If the market does break higher, and I expect that, I hope that to happen at least, then I'll be playing intraday bull flags. So that's my thesis. My trades on the intraday basis are built off of this higher time frame level. So it's more cerebral, but it's more thinking based, because that's what I do is I set the picture up and then aggressively play the lower frames, 5-minute chart, 1-minute chart. And if traders can do that, I'd hopefully advise following along to play the breakout into the intraday chart. Again, it's like this. Markets, when they move, they don't just go straight up or down. They pull back. So I would highly recommend, if the trigger occurs above 1900 S&P, to play the subsequent retracements on the way up. And so that's mainly what I do. I do a few things in the higher frames, but I focus, I'd say, 80% of my attention on these lower frame charts of the S&P.
Okay, interesting. So you're more at day trading these, especially, you said you're trading this market tactically. Is it daily, weekly? How are you trading? In and out, quick strike, couple hour, or if you see something turn pretty quickly?
Yeah, and what I do is, the thesis was, just for reference to kind of go back, was a bearish reference, and on the way down, and when the market breaks, you basically sell short sell these retracement flags. So we expected a bounce up on the break. So all you're doing is basically, that's the biggest success or style of trading for me that works, is retracement or flag style trading. And as the market moves toward or away from a level. So that bigger picture is always in mind. And so right now we're having a push up. As an intraday trader, I'm going to focus my attention just on playing in the direction of that movement and not trying to get confused, not trying to play short against it. And that's mainly what I do. It's just helped me a lot. It's given a clarity of mind. You're not just jumping around short, long, short, or indicator driven. You're based on a thesis. A narrative drives your thought process, and from that, your individual trades take place. So there may be 2 to 3 trades per day, sometimes up to 5 if it's a trend day, and a trend day opens at the low and closes at the high. Usually starts with an opening gap. Those are by far the most profitable for me on a monthly basis. In terms of my monthly account, would grow the most by aggressively trading trend days. And there's about 4, 5, or 6 of them that happen per month. And so that's the core of what I do personally, is aggressive trend style trading in the direction of what I'm thinking, or at least forecasting, from this daily chart and even sometimes a weekly perspective. But it's just, where is price at? Where is it? It's moving toward or away from. And it's back to market market profile principles, or price auction theory. You're asking, where is the market headed toward, and how well is it doing it? If the market's heading toward a level with higher volume, momentum, internals, you want to trade that aggressively in that direction. So that's mainly what I do, is thesis building and then pullback trading as the market moves toward or away from the level. So we're moving it, just for reference, up away from the 1800 level toward this 19. So we got this late last week. That was a good target move up. We're already here. So the thesis would be at this point neutral, bullish if above 19, buy those flag retracements on the way up. And if you don't trade S&P futures, the same logic would hold in multiple stocks, like Apple, which reports earnings. Same thing. So if Apple breaks above 101, 102, we'll be aggressively, I won't, but that may be a trade, to aggressively buy those retracements as it targets higher levels with the market. So even if you don't trade futures, the listeners, the readers can do the same thing. Plan a thesis, plan a game plan, and then trade in that direction using options, ETFs, individual stocks, futures, whatever the case may be. But just don't, the best advice what I do is don't take trades in isolation, make them part of something bigger. And so that's, again, back to Apple. If it breaks above that, it's the same logic for the S&P. Probably trades up. You want to be an aggressive buyer of the pullbacks, just as it trades down, aggressive short seller of the pullbacks.
Like it. Sounds really good. All right, Steve, over to you. What's a good juicy trade you're looking at right now?
You know, I'm looking at the weekly chart on the SPX, and like I talked about last week's price bar was quite significant. You know, there's a lot of confluence going around there, and so if the market breaks 1909, all right, that would be above last week's high, and then what we would look at would be something like a credit spread set with the short strike below last week's low. You'd put it around 1800, and you could do a credit spread down there out in March, 1800, 1790, and when you model that out, you'll have about a 1-to-1 reward to risk ratio. The probabilities will be significant. You know, probably in the 70% range, something like that, and you know, that's something I'm looking at, and I think it makes a lot of sense from a technical analysis standpoint, putting the odds in your favor, selling premium in the direction of what would appear to be hopefully the new trend.
Okay, Andrew.
What does Nicole think?
Exactly. Nicole just got a dozen roses, so she's actually pretty happy right now.
I'd be happy if I had a dozen roses.
Exactly.
I'll be looking to trade the option market in a lot of stocks with earnings. So, you know, I specifically have a trading plan that I use for trading earnings, and I look at the historical movement of stocks on earnings, and then I look at the implied movement. So I'll be looking to get long Facebook for earnings. I'll probably be putting on call butterflies. I haven't decided what I'm going to do in Apple. I think I'm going to probably get short Apple, but I specifically like to trade the weekly options using my earnings plan for trading measured move targets. So a lot of earnings trades I'll put on this week.
Okay, let me let's do that so you guys can see my screen here. You guys can see my screen, right?
Yep.
Okay. Yeah, it looks like we're breaking below 1900 a little bit. I like Andrew's line of thinking, using weekly options as well. I just got filled on this trade a couple minutes ago. Like I said, this is the 1930.
Hey Matt, I think you're sharing the wrong screen or something. It's just showing the.
Let me try that again.
The show window.
Okay. Let me try full screen. How about now? Trading platform?
Yeah, I can see it now.
Okay, perfect. So here we are with the S&P 500 breaking down. There we go. So here's the weekly options trade I have on. Like I said, I'm bearish, and like Steve said, you'd like to be a net seller of options. So I just filled this morning and sent this out to at least my subscribers. I sold 15 of the 1930 calls. and buying as a hedge, just like Steve said, hey, have a hedge to the upside. We do spreads, the 1935 calls. Pretty high, using current at the money volatility, pretty high probability trade of, 3 out of 4 times, essentially, this trade is going to be max profit. So, but if we get that rip your face off rally that maybe Corey is looking at a little bit, this trade will be in trouble. But I also send out what I call an adjust and an eject level in the trade. If I lose double the credit that I took in, 240, I get out of the trade. I'm done. That's it. Give the jet back to the taxpayers. I eject. But I also send out a point where I'd like to adjust it, maybe roll it up and out, or whatever. And that's usually at about 75% of the credit that I took in. So this is a trade that I like for the week. A couple other trades that we have on right now are OIH, the oil services industry. This one's looking great. This expires here in February, up about $1,000 right now. Very, very bearish on the oil services industry. So we have a couple bear call spreads, and also on the XLE, the energy sector. Why? It's kind of a duh. Literally a dud trade. With oil down here in the upper 20s, low 30s, a lot of these oil services companies are going to go bankrupt. Period. They're already laying off a ton of people, and that's the step right before either going bankrupt or Chapter 7 or something like that. So with oil, even if oil rally, Saudi Arabia and Iran attack each other tomorrow in the middle of the Gulf and start smacking each other around in their face, it doesn't matter if oil goes to $200 a barrel tomorrow. It's already too late. We've been down here for too long. So I definitely take a look at the oil services industry and be bearish as heck on those. It just doesn't. In addition to the Iranian sanctions being lifted due to our Manchurian candidate in chief, President Obama, they're going to be flooding the oil market with a million barrels of oil potentially a day. They're already ramping up to 300,000, getting ready to deliver to Europe. It's bad. It's bad in the oil sector, and it's not getting any worse. So those are two of my personal trades that I'm looking at right now. Bear call spread on a weekly, and then some bearish call spreads on the oil services industries out to February. Could be completely wrong and an idiot. I hope not. So all right, I'll tell you what. Let's go around the room, and one more question for you guys. Let's take a look at potential longer term. What's your? I mean, we're all very tactical right now. I think we can all agree that, hey, man, this is a little nuts. There's a little bit of hey, what are you doing? What are you doing going on? What's your longer term plan here? Meaning, past a couple months, out of this economic Vietnam we're running around in right now. Corey, I'll start with you.
Yeah, definitely. I am getting nervous. On a bigger picture, I'm not bearish on a person that gets super, super bearish, but I'm not liking what I'm seeing in terms of breadth, in terms of divergences. The chart here doesn't go that far back, but I did a blog piece out for members this weekend with respect to the comparisons of 2000 with this. Was similar divergences in volume, momentum, internals, and 2007 before the market fell apart. But that's the same thing. We bet on trends to continue. That's number one probability until the trend reverses. And we look at lots and lots of factors. So at this point, you're seeing similar, is the chart showing on the screen? You're seeing similar rollovers, if you're seeing the screen there, to the principal 2000 and 2007. So that, if you sort of look at breadth, this is stocks making new 52-week highs and stocks making new 52-week lows. This chart to my left, and this is the stocks above moving averages. Anyway, this has got me concerned. I'll be kind of blatant about that. I don't like the picture I'm seeing on the bigger frame. As an intraday person, I'm really directionally neutral, but the bigger picture does drive everything that I do. And if this market does start to break lower, it's already making lower lows, lower highs, negative moving average structure, and of course, you're seeing distribution. If this market starts to fall, we're targeting 18, 17, and probably even lower than that. So bigger picture concept, I'm really, really, really watching 1860, 1870, and the prior low from 2016. If that's gone, you can see the possible future, and that is, we'll go over to the monthly chart, it's going to be to the downside. So kind of similar analysis to just go back and compare on your own time. 2007, 2000, and this rollover distribution top right now. So longer term, I got the heebie-jeebies a little bit in terms of this market. So that's what I'm looking at.
I think it was Gunlock the other day. He also said, hey, we've been living above our 200-week moving average. He's like, there's a lot of room between our downside right now and hitting that thing. So I couldn't agree more. Okay, Steve, how about you? Longer term, what's your take?
I'm sorry, you cut out. Are you talking to me, Steve?
Yeah, you bet. What's your take longer term?
On a longer term perspective, I mean, what I just heard, I found that very interesting. The one caveat, something I look at every week is the percent of stocks on the New York Stock Exchange that are experiencing a point and figure buy signal. It's stockcharts.com. It's $BPNYA percent index, and when that thing gets below 20. Quite often that corresponds to a pretty significant market low. Now right now it's around 25, so it's been coming down for several weeks now, and now it's getting into the area where you start having the contrarian mindset. You start putting that contrarian mindset, and it goes like clockwork. When that thing gets down around 20, 15, now the crowd is typically that point. I mean, really, at that point are really, 75, 80, 85% of the stocks not worth buying at that point. Well, that's when the crowd is wrong, and then the contrarian mindset can kick in with what appears to have been pretty good success going back over the years. So that's the one market internals that has me pausing about, the negative picture, which what you just presented, what I just heard was, I think, outstanding. So that's my one caveat, and so that's something I'm looking at longer term, would be that BPNYA at stock charts.
Awesome. Okay, Steve, I appreciate that. And Andrew, your longer term, once we get through this.
Yeah, I mean, most of my trading is shorter term, but if I had to give my opinion longer term, I think the stock market goes higher. It's always interesting from my point of view. I do watch a lot of TV, CNBC, hear a lot of commentators, and we usually take the escalator up and then we take the elevator down. So when the market's starting to sell off, everybody in the world has now become bearish and think the market's going to roll over. I think we've rolled over pretty well. We tested a 10% correction. We tested down to 1800. We have the big tail on the bottom on the daily chart at 1800. So I think the market's going to continue higher. I think oil can only go higher from here. I am not in the belief that oil goes to $18, and there's a lot of oil services that are going to go out of business. I just don't see it. I'm not seeing it in the order flow from institutional orders. We actually see a decent amount of longer-term oil bets. So I do think the stock market will go higher. When we do snap back, because we will snap back higher, then you'll find everybody on TV that's now bullish again, that said, told you to buy the dip. So I think we move higher from here. Hello?
Okay, higher from here. Okay, I'm gonna go right down the middle of the fairway here. I think we go lower for now, or wallow. I don't see another rip your face off rally. There ain't no reason to. China sucks. It's I'm old enough to have watched the $6 Million Man growing up. It's like Steve Austin crashing down the runway, just tumbling in a ball of flame and smoke. That's China. And when China sneezes, the rest of the world catches a cold. I think the Fed does maybe put the brakes a little bit on raising interest rates to maybe help us out a little bit. Oil is, I don't think it's going to rip higher anytime soon, but it's definitely, who was it, Credit Suisse, or one of them. I read a report the other day where they're like, expect $30 a barrel at least for the next 2, maybe 3 quarters of this year, which just is horrible for the economy.
Was it 20 or 30? It was 20, wasn't it?
Yeah, 30. 30. They said expect 30-ish oil, upper 20s, lower 30s.
Oh, I thought it was 20. Yeah.
Yeah, next couple quarters, and I know you guys all know this, but every time I talk to new potential TGO folks, low oil is horrible for the economy. And it's people are like, wait a minute, I saw this guy on CNBC say, it's low gas is great. I'm like, that's because he's a complete idiot. I was going to say something meaner, but I don't want to get in trouble. Low oil prices, like we talked about, Schlumberger laying off 15,000 people. I've been to Midland, Texas. I've done consulting for an oil company. I've driven in a pickup truck for 150 miles to the middle of nowhere. Those guys are making $100,000 a year. They live in houses. They eat at diners before they go. When you don't build refineries, when Exxon says, hey, we don't need that, $1 billion super tanker that is going to be built in that shipyard, bad things happen when oil is down here. So I think other than that, Mrs. Lincoln, how's the play? I don't think we're heading higher anytime soon. But to Andrew's point, I mean, freaking duh. And Corey's, markets go up over time. It's just in 2008, everybody thought, my God, this is it. Cats and dogs living together, mass hysteria. The sun rose. We came out of the ash. I thought we should have let everything go bankrupt, but we can talk about that over a beer. That was stupid to bail everybody out. So I do think we go higher. If I was bottom picking right now, a couple trades I'd look at. Apple, easily. I just did a long call diagonal with a protective put the other day for my traders, and even though I just slammed the hell out of them, China. I mean, China they're in it for the long term. I'd be looking out to January 2018 and getting bullish on China as well. If they don't figure their stuff out by then, we're even in more trouble. I mean, literally. So that's my take on that, and I could be completely wrong. I'll tell you what. Let's go around the room one more time for closing thoughts, closing comments, and also where they can get a hold of you and what you do where you are. Because a great panel today, and it sounds like a lot of the listeners might be interested in reaching out to you and hearing more. So Corey, why don't you close this out with yourself, man?
Sure, man. I definitely watch the Fed. That's something, the Fed policy QE1, QE2, QE3. When the Fed is printing, the market goes up. When they don't, the market goes down. So I definitely watch them, and I 100% agree. They will not be raising rates anytime soon, but that's going to help the market at least as they come out Wednesday and beyond. So the Fed is your big driver, as is other central banks, but that's a big kind of fundamental picture. Keep looking at levels as a trader. If you're new, just focus on price, focus on trend, and go with the trend. Don't fight trends. Price exists, and trends exist for a reason, and it's better to go with them than against them. Reference oil and other things too. Big advice there. But yeah, I'm Corey at AfraidToTrade.com. I have free commentary each day, do leading stocks, sector rotation, and kind of bigger picture things for free on the blog at AfraidToTrade.com. Otherwise, in-depth planning and educational materials, psychology and intraday tactics and trend tactics, retracements, trading, basically just strategies there at AfraidToTrade.com. And again, thanks for having us, and I look forward to seeing you again.
Awesome. Thanks, Corey. Appreciate it. Steve.
Well, first of all, thank you for having me. I certainly enjoy this. I enjoy hearing all the other perspectives. You could reach me at steve@discoveroptions.com. We love to combine some of this kind of the analysis of the markets and with option spread construction. If you're considering getting into that a little bit more than what you are, give me a shout.
Awesome, Steve. Thanks for coming. We certainly appreciate it. And Andrew.
Yeah, you can get a hold of me at Andrew@Keane on alphachart.com. Andrew@alphachart.com. One thing, like I said, I keep an eye on the VIX. I keep an eye on oil, and I'll be listening to what the government has to say, the Fed has to say. I don't think they're going to raise interest rates or prelude to raising interest rates at all on Wednesday, so I do think we get a rally. We run a trading room, which is 8 hours of audio and visual. I'm in there for 3 hours a day talking about trading, talking about the stock market, kind of a substitute to watching CNBC all day. So if you're interested, you can email me at andrew@alphachart.com.
Awesome, Andrew. Appreciate it. Thanks for coming. And Andrew does have a tight ship over there, folks. He's in the market all day. So if you want to look over the shoulders of a pro doing some good work in the options market, definitely stop by and talk to Andrew. And guys, guys, my name's Matthew Buckley, Wiz with Top Gun Options. I don't trade all day like Andrew does. We have live trading throughout the week for maybe hour and a half-ish, and you can check me out. Wiz at Top Gun Options is my email. That's a real tough one, WHIZ at Top Gun Options, and would love to hear from you, or if you'd like to check out some of our services as well. With that, David, I'm going to turn it back to you, my friend. Looks like we had a little bit of disagreement, a little bit of agreement, and we got some good stuff, and we pulled some potential trades out of the guys as well. So thanks for letting me host, and I'll throw it back to you, my friend.
Yeah, thanks, guys. It's a great show. Just want to remind everyone that if they haven't taken a look at the report yet, there's always some stuff in the report that we don't get around to talking about on the show. So just go to TimingResearch.com/reports, and you can download this or any past report there. Just want to thank all my guests again: Andrew Keane of AlphaShark.com, Steve Lentz of OptionView.com, Corey Rosenblum of AfraidToTrade.com, and Jonathan Rose of ActiveDayTrader.com was supposed to be on today, but he had to cancel, so hopefully we'll have him on again soon. And Matt Buckley of TopGunOptions.com, thank you for hosting again. Yeah. All right. Thanks, guys.